The Intelligent Investor by Benjamin Graham is a timeless classic in the field of value investing, originally published in 1949 and revised several times since. This book provides invaluable insights and principles for both novice and experienced investors, emphasizing the importance of a rational and disciplined approach to stock market investing. In this summary, we will cover the key concepts and principles presented in the book. 1. Investing versus speculating. Graham differentiates between investing and speculating. He defines an investor as one who approaches the stock market with a long-term perspective, seeking safety of principal and a reasonable return. In contrast, speculators are focused on short-term price movements and often disregard fundamental analysis. 2. Margin of safety. Graham's most famous concept is the margin of safety. He advises investors to only buy stocks when they are trading below their intrinsic value, ensuring a buffer against potential losses. This principle encourages caution and risk management. 3. Mr. Market. Graham introduces the metaphor of Mr. Market, an imaginary business partner who offers to buy or sell stocks at various prices every day. Mr. Market's moods are unpredictable, and the intelligent investor should not be swayed by his emotions but should take advantage of his irrationality. 4. Market fluctuations. Graham acknowledges that market prices can be irrational and subject to fluctuations. He recommends that investors adopt a long-term perspective and avoid reacting emotionally to short-term market movements. 5. Defensive versus enterprising investors. Graham categorizes investors into two types, defensive and enterprising. Defensive investors are risk-averse and prefer a passive investment approach, typically using diversification. Enterprising investors are more active and seek individual stocks that meet their criteria. 6. Diversification. Graham encourages diversification as a risk reduction strategy for defensive investors. Spreading investments across different asset classes and industries can help mitigate the impact of poor performance in any one area. 7. Stock selection. For enterprising investors, Graham provides a framework for stock selection based on fundamental analysis. He suggests looking for companies with a history of consistent earnings, strong financials, and a reasonable price-to-earnings ratio. 8. Bonds. Graham discusses the merits of investing in bonds as a stable source of income. He emphasizes the importance of assessing bond quality and suggests that bonds should be a part of a balanced portfolio. 9. Market timing. Graham is skeptical of market timing and suggests that it is nearly impossible to consistently predict market movements. He advises investors to focus on intrinsic value and not try to time the market. 10. The investor's psychology. Graham explores the psychology of investing and the impact of emotions on decision-making. He highlights the importance of maintaining discipline and objectivity in the face of market turbulence. 11. Investment versus speculation. Graham draws a clear distinction between investment and speculation, emphasizing that investors should thoroughly analyze stocks before purchasing them, rather than simply betting on price movements. 12. The role of professionals. Graham is critical of financial professionals who may prioritize their fees over the best interests of their clients. He advises investors to be cautious and informed when seeking professional advice. 13. The margin of operations. Graham introduces the idea that a company's profit margin should be scrutinized, and investors should favor businesses with a history of consistent profitability. 14. The defensive investor's portfolio. Graham provides a sample portfolio for the defensive investor, consisting of a mix of bonds and stocks. He offers guidelines for asset allocation based on the individual's risk tolerance. 15. The enterprising investor's portfolio. For those willing to put in more effort, Graham provides a framework for building an enterprising portfolio that involves selecting individual stocks based on rigorous analysis. 16. Inflation. Graham addresses the impact of inflation on investments and suggests that investors consider inflation-protected securities and equities that can withstand inflationary pressures. 17. Market history. Graham offers historical perspectives on market crashes and bubbles, emphasizing the cyclical nature of financial markets. 18. Investment versus gambling. The book draws a clear line between responsible investing and speculative gambling, highlighting the importance of prudence and thorough analysis. In conclusion, The Intelligent Investor by Benjamin Graham is a comprehensive guide to sound investment principles. It emphasizes the importance of a disciplined, long-term approach to investing, focusing on the intrinsic value of assets rather than short-term market movements. Graham's ideas continue to influence generations of investors and remain highly relevant in today's financial world. Whether you're a novice or an experienced investor, this book offers valuable insights into building a successful and sustainable investment strategy.